Welcome to Breaking News to Trading Moves. Imagine knowing your company's absolute best asset, the product paying for the lights, the salaries, the dividends, is going to face fierce competition in exactly 4 years.
Yeah, that is a tough spot to be in.
Right, and that is the exact reality for Merck right now, because in 2028, their blockbuster cancer drug, Keytruda, loses its patent exclusivity.
Yep, the 2028 patent cliff.
So how do they fix a multi-billion-dollar revenue hole? They grab the checkbook. Right now, Merck is nearing a roughly $6 billion all-cash acquisition of Terns Pharma.
$6 billion all cash. It is a major move.
It really is. We are looking directly at this headline today to connect the dots and identify the clear winners and losers across the market. For you listening, the immediate market reaction was swift. Terns shares jumped about 10% in after-hours trading.
Which, makes total sense given the premium.
Exactly. Our goal today is to strictly cover the reported transaction details, who benefits and who faces pressure as a result of this capital allocation. Let's start right at the epicenter with the direct target and the buyer's motivation.
Sounds good.
So Terns Pharmaceuticals, trading under the ticker TERN, is the obvious immediate winner as the direct target of this all-cash bid.
Oh, absolutely. They're the immediate beneficiary here.
And Merck, ticker MRK, is making this move to strengthen its cancer portfolio ahead of that 2028 patent expiry. It feels a bit like watching a sports franchise trade away their next 5 years of draft picks just to get a rookie star.
Right, because their Hall of Fame quarterback is retiring.
Yes, exactly. Is that what Merck is doing here? Are they just buying an expensive lottery ticket to replace Keytruda?
I would not call it a lottery ticket. It is much closer to calculating probabilities based on hard clinical data.
Okay, so less gambling, more calculated risk.
Right. The reality of patent expires in the pharmaceutical industry dictates these exact moves. It is entirely about the mechanics of cash flow.
Walk us through those mechanics.
Well, when a medication like Keytruda faces a patent cliff, the exclusive rights to sell that treatment just end. Overnight, generic competitors can enter the market.
Wow, literally overnight.
Literally. And when those generic versions arrive, the original manufacturer does not just see, like, a gentle dip in sales.
It's more severe than that.
Much more. They face a steep, entirely predictable collapse in revenue for that specific product. Because pharmacies and insurers, they immediately switch to the cheaper generic alternatives.
So they have to see this coming from miles away.
Exactly.
Yeah.
Because of that impending cliff, the corporate strategy has to be replenishing pipelines early. Large drug makers are willing to pay aggressively for oncology assets.
Because the revenue gaps pose a major strategic issue for their whole business model.
Right. They simply cannot wait until 2028 to find a replacement. The regulatory process takes far too long.
Yeah, you can't just invent a drug in a month.
No, not at all.
Yeah.
They must secure new therapies years in advance to ensure continuous revenue.
That makes total practical sense when you lay out the timeline like that. They're basically prepaying for future revenue to mask the bleeding when generics hit the market.
Yeah, buying time.
Paying a premium today to avoid a massive gap on their income statement tomorrow.
Exactly right. And that $6 billion price tag we are looking at, that sets a firm valuation benchmark for the entire sector.
Okay, so it puts a price tag on the whole neighborhood, basically.
Right. Because buyers like Merck are showing they are willing to pay meaningful premiums for these assets, we logically move from looking just at Terns to evaluating other companies that share a similar profile.
It tells the broader market exactly what large drug makers value right now, down to the exact dollar amount.
Yep, so if Merck just set the floor at $6 billion, the price of poker just went up for everyone else.
That benchmark brings us directly to our next category, the M&A premium winners.
The broader read-through for takeover candidates.
Right. In the U.S.-listed biotech sector, this points to companies like Exelixis, ticker EXEL, and Incyte, ticker INCY. Both emerge as clear winners here.
Yes, both are U.S.-listed, oncology-focused names.
And they fit exactly into what institutional traders call the read-through trade.
Let me explain how that actually functions on a trading desk for you listening. When one pharma giant pays up for an asset, portfolio managers immediately start hunting for other late-stage cancer assets.
Looking for the same strategic value.
Exactly. They run screens looking for the exact same characteristics Merck just bought. The market treats the Merck acquisition as a bright green signal of active buying across the sector.
So it proves that capital is actually being deployed, not just, talked about in boardrooms.
Right, the money is moving. That creates a direct, immediate financial incentive for investors to identify who might be purchased next.
Which drives up the stock prices of those candidates before a deal even happens.
Exactly.
But walk me through the psychology there. Do investors just throw darts at any random oncology stock when a deal like this happens?
Oh, no, not at all.
Or do they demand specific late-stage clinical progress before they start allocating capital?
They absolutely demand specific late-stage clinical progress. And the reason goes right back to that 2028 timeline constraint we just talked about.
Right, the ticking clock.
Exactly. Early-stage research, the stuff still in phase 1 trials or just being tested in a lab, is way too far away from generating commercial revenue.
It won't solve a 2028 patent problem.
Nope. Investors look for companies that have completed or are nearing the very end of their clinical trials. Companies like Exelixis and Incyte fit this mold perfectly.
Because they have mature pipelines.
Right. They represent de-risked assets that a larger company could acquire, run through the final regulatory steps, and integrate relatively quickly.
So a promising idea in a lab does not help a large pharmaceutical company replace lost revenue on a strict, looming timeline.
Exactly. The asset has to be ready for the market.
That distinction is crucial for anyone watching these stocks today. It is not just about being in the cancer space, it is about how close you are to the finish line.
Spot on.
So after establishing that smaller oncology targets attract fresh investor capital, we have to recognize that every transaction requires a buyer.
Right. Someone has to write the check.
Exactly. Let's look at the large cap pharmaceutical companies that have the means to make these purchases. How established players benefit from this focus on oncology is a key part of this headline.
Yes, it is.
Merck, Bristol Myers Squibb, ticker BMY, and AbbVie, ticker ABBV, fall into the winner category here.
Right. Merck is viewed as a winner by the market because traders can conclude they are acting proactively.
They aren't just sitting on their hands.
Exactly. They are not waiting for Keytruda's revenue to vanish. They are addressing the 2028 patent cliff head-on.
And what about Bristol Myers Squibb and AbbVie?
They get what we call sympathy interest.
Sympathy interest, okay.
This happens because investors look broadly across the sector for other U.S.-listed pharma names with established oncology exposure.
And, crucially, the massive balance sheets required to stay active in business development.
Exactly. If oncology assets are suddenly in high demand, the companies holding the capital and the existing infrastructure look much stronger to the market.
It feels like Bristol Myers Squibb and AbbVie are cash-rich buyers at a high-end real estate auction who already own property in the neighborhood.
That is a great analogy.
Their existing portfolios look better just by association with these rising valuations. They have the funds to participate in the auction, and the assets they already hold become more valuable as the market price goes up.
That is an incredibly accurate way to look at the sympathy interest.
Thanks.
When the market decides that oncology remains one of the highest value areas in big pharma, companies seen as serious cancer players attract fresh interest from institutional buyers.
So the focus lands squarely on pipeline quality and deal optionality.
Right. Having an existing sales force and distribution network for cancer treatments means if AbbVie or Bristol Myers buys a new drug, they could plug it directly into their system.
And sell it immediately. That infrastructure is a massive advantage.
It really is.
Wait, hold on. I need to stop you there. A minute ago, we put Bristol Myers Squibb in the winner's circle because of their existing portfolio and balance sheet.
Yes, we did.
But looking at the other side of this headline, we are talking about the downside for rival big pharma companies. Pfizer, ticker PFE, Gilead Sciences, ticker GILD, and Bristol Myers Squibb face pressure as losers. Walk me through that contradiction. How can Bristol Myers Squibb be a winner and a loser at the exact same time?
I know it sounds contradictory, but it comes down to the dual nature of M&A pressure.
Okay, let's break it down.
Owning good assets is a positive, which is why Bristol Myers Squibb appeared on the winner list. The market values their current portfolio higher today than it did yesterday.
Okay, that makes sense.
However, they, along with Pfizer and Gilead, face the very real strategic headache that securing future pipeline additions just became much more expensive.
Oh, because the price floor went up.
Exactly. It is a competitive race for specialty assets. If Merck moving first pushes up valuations for attractive oncology targets across the board, these rivals may have to spend considerably more capital.
Just to secure similar pipeline additions.
Right. The risk for Pfizer and Gilead is not that this specific Terns deal directly hurts their current earnings today.
It is that the headline reminds investors how fiercely competitive the race for quality oncology assets has become.
Spot on. Even strong established players face a more expensive landscape going forward. Their cost of future growth just went up.
Okay, that makes the contradiction perfectly clear. Holding the assets is a win, but needing to buy more assets in a market where the price tag just went up is a loss.
Exactly.
That explains the large cap pressure. What about the smaller names in the biotech space? We see smaller biotechs like Karyopharm Therapeutics, ticker KPTI, Autolus Therapeutics, ticker AUTL, and ADC Therapeutics, ticker ADCT, categorized as losers here.
Right. Those companies fall into the category of lower priority biotech names without immediate takeover appeal.
So why are they lagging behind?
They lag behind strictly because of the mechanics of capital rotation.
Capital rotation. How does that work?
Well, in a market driven by merger and acquisition headlines, investors often crowd into perceived takeover candidates. Portfolio managers allocate their funds to the names they think are most likely to be acquired next.
Like the late-stage oncology names we discussed earlier, Exelixis and Incyte.
Exactly. And when that institutional money moves, smaller biotech stocks without an obvious strategic bid angle get overlooked and sold off.
So to be clear, if you are listening and you are holding one of these smaller names, it is not about negative news coming out of their specific clinical trials today.
Correct. These names are not losers today because of any company-specific negative news or failed drug trials.
The trading risk playing out here is purely relative performance.
Exactly. Institutional capital actively rotates out of speculative stories to chase the active takeover candidates.
Think about it from the perspective of a fund manager with strict risk limits.
Right. If that manager wants to buy 1 million shares of a late-stage oncology company because they think it's the next acquisition target, they need to free up cash.
So they might sell their shares in Karyopharm, Autolus, or ADC Therapeutics to fund that purchase.
Yep. That active selling pressure creates the downside, leaving those speculative early-stage stories behind while the rest of the sector moves higher.
Now that the mechanics of exactly who wins and who loses are mapped out, and we understand how that capital is actually flowing around the market, it is time to give you, the listener, the exact metrics to track going forward.
Right, the actionable takeaways.
The overarching takeaway is bullish for Terns Pharmaceuticals first, and supportive for U.S.-listed oncology biotech sentiment broadly. If this reported deal is confirmed, watch for 3 specific things. First, whether other oncology biotechs rally in sympathy.
Watch the tickers we mentioned to see if the read-through trade actually materializes on the tape.
Right. Second, watch whether large pharma peers start moving on fresh M&A speculation.
The pressure on companies like Pfizer and Gilead to respond to Merck's aggressive move could really drive further acquisitions.
If the cost of assets is rising, they might feel pressured to buy now before prices go even higher.
Exactly. And third, watch whether investors reward Merck for their pipeline discipline or worry about their deal pricing.
A $6 billion all-cash deal is a major capital allocation.
It is. The market will weigh the long-term benefit of the new assets against the immediate cost of the acquisition.
Before we conclude, consider what it means for the broader healthcare landscape. When a primary growth strategy for industry leaders becomes buying innovation at a premium, rather than building it in-house, does that change how medicine advances? Something to think about.
Yeah, that is a great point to end on. And as always, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.